Tuesday, February 5th, 2019, Monaco 64, home of alternative economics and contrarian views. This morning I want to talk about Brexit. And no matter what you think of Brexit, no matter how you voted in the EU referendum, if you're in the UK, this is a completely different look at it. It's my contrarian look at it. And I'll talk how I think Brexit is the biggest distraction in modern UK history. Distraction for what? Well, to keep bailing out the City of London after the debacle of 2008. And I'll try to convince you of that today. Before that, of course, we're going to look at what the markets are doing this morning. It's just gone past 8:15 a.m. London time. So let's have a quick look at the financial markets this morning. Spot gold is at $13.40, so it's up just over $1 from overnight. The range has been $13.11 to $13.15.60. Silver got hit quite hard yesterday. It was kind of a continuation of what happened Friday afternoon in the US. Silver was doing very well, up around 16.20, and then all of a sudden it dropped towards 16, and it continued yesterday. I think we traded down to 15.60, but it's rebounded quite well. We're at 15.90 right now, up about 3 cents. Range has been 15.95 high to 15.79. So the stock markets continue to rally. Yesterday we saw, I think the Dow was up 175. So we're at 25,234 this morning, down about 5. The futures, S&P is down about 4 points, 2720. NASDAQ 100 future is down 1/3% at 69.33. The currencies, and today I'm going to talk a little more in detail about the British pound when I come up to my Brexit theory. So at the moment, the pound is just holding on above 130 against the dollar. It's at 130.31, down about 5. Range has been 130.25 to 130.54. The euro is at 114.17, so that's down about 0.2%. And the dollar has been fairly strong against the yen and the yuan the last few days. This morning, though, dollar is unchanged against the yen, 109.88, and it's down about 0.2 against the Chinese yuan at 676. Crude oil, WTI, 54.82, so back below 55. Not much there. What about the bond market? The U.S. 10-year yield right now, 272, unchanged. The 1 to 5 spread, the T-bill, 1-year T-bill to 5-year T-note spread is still inverted. It's around 4 basis points inverted. Brexit. I've been talking about first it was it was called the EU referendum. Didn't really have a term. Brexit wasn't used as much, but yeah, I was speaking about it before the vote on June 23rd, made videos about it, and I repeated many times that it was going to be used as a scapegoat for all the economic problems that we would see from then on. And it has. I mean, the other day I was in a shop and I could hear people talking, something went up and they said, oh yeah, it's Brexit. So everything now, even inflation is blamed on Brexit. And to look at inflation, we need to look at the true definition of inflation, because monetary inflation is purely a monetary phenomenon. A lot of people, and I mean, I'm guilty of it. If something, the price changes, you say, oh, this thing has gone up, But if you think about it, the value of things don't really change. A cup of coffee doesn't change from a year to year, but it's the value of the money that goes down. But the way the powers that be, the central banks, the politicians get away with it is that people have been brainwashed into thinking that prices go up, prices of things, instead of saying that the money is going down. And you might say, well, but we always had inflation. But no, when Britain was an empire and we had the Industrial Revolution, the country grew, the middle class came about from, in the late 18th century, 19th century, for 200 years, from when Sir Isaac Newton put the UK on a gold standard until 1914, there is virtually no inflation in this country of the money supply. Prices were very stable, even though it was a period of great growth. The UK became the major economic power on the planet. So, yeah, that's one thing we need to look at. Inflation. Nowadays, if you listen to economists who work for the City of London, who benefit from this system, they all look at inflation as a government statistic called CPI. And if that gets too high, they look at the core CPI, which subtracts the things we most need, like food and energy. So to them, yeah, inflation's always around 1 or 2%, even though we know that it's more like 4 or 5 or even 6. And I highly recommend shadowstats.com by John Williams. It is a look at how the American government has lied about inflation. Not lied, but they just changed the way they calculate it. John Williams basically looks at how they calculated in the 70s, 80s, and 90s, and uses that methodology for today and shows that the cost of living are actually rising by 5-6%. But anyway, why is Brexit? I've gone on a little bit about inflation, but that's important for us to know. Why is Brexit, in my opinion, and as I said, this video is not about my opinion about Brexit. That's all for me, distraction. Of course, you might want to leave or not. That's not the point of the video. The point of this video is to try to help you maybe, how can I say, safeguard some of your savings, because what I think is happening is a big distraction to keep saving the City of London banks. And why do I say that? Well, we just have to look at what happened to the British pound right after the 2008 crisis. Most people nowadays, they think the pound is weak because of Brexit. But just before, the SH, and I don't want to say the word, hit the fan in 2008, the pound would buy more than $2. And you can see here on this chart. Pound is quite strong. It had come up from around 140 the beginning of the century, all the way to 2 by 2008. But when the crisis hit, RBS collapsed, had to be bailed out. Northern Rock went bust. Lehman went bust. Look what happened to the pound. We dropped from a high of 211 in November 2007 to a low of 135 in February of 2009. So in less than 2 years, the pound collapsed. And why was that? Well, because in order to save the banks, they had to devalue the pound. They had to print the money, bail everyone out, and the pound goes down because you create a lot of pounds, while other currencies aren't inflated as much. So you can see there that the biggest drop really was after the 2008 crisis. After that, it stabilized. It went back up to 170. When was that? 2014. And then, David Cameron, I think he announced the referendum about, spring of 2015. And, before then, the pound had already gone back below 150. So what I'm trying to say is this debasement of the pound, and when you debase the currency, you make the currency worth less. And that's where you get the inflation. And that's why I was saying earlier on that it's not prices of things that go up, it's the currency that goes down. So you can see that most of the debasement of the pound happened way before even the announcement of the referendum and even after Brexit. Yes, Brexit has accelerated it, but in my opinion, it's not, maybe the uncertainty for Brexit might be causing the pound to go down a bit. But in the end of the day, I think it's they're using this, as a huge distraction, like killing two birds with one stone, to keep the city going. Because it would be, without a referendum or a Brexit crisis, it would be impossible to justify bailing out the banks. I think people were sick of what happened in 2008, 7 and 8, and they would never accept more bailouts of the city. But that's what's happening. And what's the proof of that? Well, the proof of that, for example, is that right after the referendum in 2016, the Bank of England intervened in the markets. They did more QE. They cut more rates. I can even show you here. United Kingdom quantitative easing. In August 2016, the Bank of England said it would buy an additional 60 billion of UK government bonds and 10 billion of corporate bonds to address uncertainty over Brexit and worries about productivity and economic growth. And I think the day after the referendum, when the vote was to leave, there's also a huge intervention by the Bank of England. That was used as an excuse as well to keep the banks going. So what do I think is going to happen? I think there are huge odds that the Bank of England will again intervene after March 29th. Even if there is a deal, especially if there is no deal. So there's a paper here by the London School of Economics. You couldn't get more Keynesian mainstream than the Gaddafi School of Economics. And why do I call it the Gaddafi School of Economics, the London School of Economics? Well, because they were endowed by Muammar Gaddafi years ago. He donated millions to that school. One of his sons graduated from the LSE. So they're saying pushing the BOE to the limit. What a no-deal Brexit will mean for UK exchange rates and interest rates. And at the bottom here, they say, Mark Carney has warned, well, Mark Carney is the governor of the Bank of England. Mark Carney has warned MPs that from a monetary perspective, we would, and I'm quoting him, we would look to do what we could to ease that no deal scenario, but there are limits to what we can do. I think there are no limits to what the Bank of England can do. We've seen in the past they can print as many hundreds of billions, or if not trillions, if they want. This is just a cover. And he goes on to say, the article, under the assumption that the impact of an economic policy uncertainty shock during June 2016 is a best case scenario of what might happen to monetary policy stance and exchange rates. The absence of a trade agreement looks set to yield further depreciations of the pound, reads saving the banks, right? Relative to leading currencies, together with a sharp cut in the bank's policy rate and another round of quantitative easing. Loosening the monetary policy lever through quantitative easing will also look to hinder possible downgrade pressures on the UK's national debt, something that will most certainly be transmitted to the private sector. In other words, a no-deal Brexit will push the Bank of England to the limit. Well, I don't think they'll be pushed to the limit. They'll do whatever it takes to keep the city of London functioning and being bailed out without, and Brexit will be a great excuse, and people will not be putting the spotlight on the on the city of London and the banks, they'll be putting a spotlight on a no-deal Brexit. Whatever you may think of Brexit, I think people need to understand that this is, in my opinion, a manufactured crisis in order to keep bailing out the banks through the back door. You might not agree with me, but that's my opinion. And how do you protect yourself as a UK saver or someone who's got a bit of savings in the bank? As always, I just tell you what I do, and that is having some physical gold and silver to protect the continued debasement of the pound or inflation that I see coming, no matter what happens with Brexit. I've got a promo code, Moneko64. You'd get a 0.5% discount from gold investments when you buy bullion from them. They're arguably the oldest bullion dealer in the city of London. If you enjoyed this video, make sure you give me a thumbs up, share it far and wide, subscribe to the channel if you haven't yet. You can also follow me on Steemit, DTube, and on Twitter. I wish you all a great day. Take care. Bye.